Welcome to today's deep dive into the platinum market. As of March 2026, platinum just plummeted from a record $2,900 down to $2,000.
Right, which sounds terrible on the surface.
Exactly. On paper, it looks like a catastrophic crash.
Yeah.
But here's the kicker. That $2,000 price tag means it is actually still sitting at more than double its 2025 levels.
Yeah, it's like the ultimate market paradox right now. If you're just looking at a short-term chart, it absolutely looks like a breakdown. But if you zoom out, well, it's actually a massive consolidation.
So today, we are solving that mystery. We are unpacking the massive forces pulling platinum in, completely opposite directions right now.
Yeah, to show why this isn't a market collapse at all, but really a highly calculated game of tug of war.
Okay, let's unpack this. To understand why it's stalled at exactly $2,000, we first have to look at the macro gravity dragging it down. We have rising interest rates, much stronger U.S. dollar, and a hawkish Fed that is just determined to keep borrowing costs high.
Right, and that environment is just brutal for precious metals, simply because, platinum, gold, and silver, they don't pay you a yield.
Yeah, it is like paying expensive rent on an empty warehouse.
Sure.
You aren't earning the guaranteed yield you'd get from simply holding treasury bonds.
Exactly.
So the opportunity cost of just sitting on physical metal becomes incredibly high for investors. It's like trying to paddle a canoe upstream against a relentless current.
That's a great way to put it. And what's fascinating here is how platinum is sharing this macro pain with gold and silver. That relentless pressure has pushed platinum down to test a critical psychological and structural support level at exactly $2,000.
Meaning every time it hits that number, buyers consistently step in. They absolutely refuse to let it drop any lower.
Yes, exactly.
So why the hard floor? If the macro gravity is that heavy, why doesn't it just keep falling?
Well, because platinum has a safety net.
Yeah.
One that gold simply doesn't possess, It is an industrial necessity. Automakers literally cannot build cars without it for catalytic converters. Plus, it is essential for all these emerging hydrogen technologies and broad clean energy systems.
And the supply side of that equation is essentially breaking down right now.
Totally. Production is heavily concentrated in South Africa.
And their output is plummeting, right?
Because of years of underinvestment and just aging infrastructure.
Yeah, that alone locks the market into a projected global supply deficit for 2026. Not to mention, industries are actively substituting away from palladium.
Oh, switching back to platinum.
Right. Since both metals serve the exact same catalytic function in engines, manufacturers are ditching expensive, scarce palladium and switching back to platinum wherever they can.
Okay, here is where it gets really interesting. But wait, if South African supply is literally breaking down and clean energy demand is surging,
Yeah.
$2,000 makes no sense.
I know, it sounds counterintuitive.
Right. By all laws of supply and demand, the price should be skyrocketing right now instead of stalling at $2. Why isn't it? Well, because institutional investors, the smart money, they aren't buying the physical metal right now. They are buying the derivatives.
Oh, so they're rotating.
Exactly. While gold and silver saw harsh physical sell-offs earlier this month, platinum options activity suddenly spiked by 35%.
Wait, 35%? Oh, wow. That is a massive influx of attention while everything else was cooling off.
Yeah, so if we connect this to the bigger picture, they aren't dumping metals. They are just getting smarter about how they hold them. By flooding into options, institutions treat platinum as a hybrid diversification play.
So it gives them the traditional safe haven protection of a precious metal, but with a hard floor underneath it because of that severe industrial supply crunch.
Right. They are essentially moving their chips to the metal with the best structural safety net.
So for you listening, platinum is currently trapped in this volatile $2,000 to $2,300 range. It is locked in a direct standoff between harsh macro conditions, that strong dollar and high interest rates, and incredibly tight physical supply.
It really is a masterclass in market inflection points. If those macro pressures even slightly ease and interest rates drop, platinum has the underlying fundamentals to easily become the strongest performer in the entire metals complex.
It's basically spring-loaded. But before we wrap up, I want to leave you with this provocative thought to chew on. If aging infrastructure in just one country can fundamentally squeeze the global supply of a metal that is absolutely vital to hydrogen tech and clean energy, well, what other fragile geographical bottlenecks are secretly threatening the global energy transition right now?
Yeah, it really makes you wonder.
It really does. Thanks for joining us on this deep dive.